Yeah, good morning, everyone. My name is Ebenezer Ademensa, and I'm a training coordinator at the Temple Small Business Development Center. The Temple SBDC helps small businesses to start and grow in their operations. We do this through our no-cost consulting, webinars such as this, and other training programs. We are also proud to be part of a nationally accredited network of SBDCs with over 1,000 centers across the United States. You have joined us today for our webinar dubbed How Does Buying or Selling a Business Actually Work? At the end of this session, a follow-up email will be sent to all attendees with the materials being used for today's session and also the recordings. And this will be done in the next 2 business days. All attendees are currently muted. However, we encourage that should you have any questions or queries, you can post them in the Q&A box or in the chat box where our presenter would answer them as and when the questions come in. I now leave the floor to our presenter for today's session, Mr. Mark, to take over the presentation. Mark, you have the floor.
All right, thank you so much. Appreciate everyone's jumping in here today over the lunch hour to go through how buying and selling a business works. I've done one of these prior for SBDC, and it's always a pleasure to help everyone out. First, just to kind of jump into a little bit about the firm, myself, and then we'll jump into the presentation. So I'm an attorney at Offit Kurman. I'm a partner here. We have 300 attorneys, over 19 offices. We have a national practice areas, really anything that covers the need for a small business owner. We primarily service privately held companies. We do very little publicly traded company work. So entrepreneurial mindset, we're one of the top 200 largest firms in the country. About myself, I really serve as outside general counsel and deal counsel to privately held companies, family offices, search funds, and entrepreneurs. So everyone who is in the entrepreneurship through acquisition space, if they're looking to buy a business, the sellers, if they're looking to sell a business that they've been operating for, however many years that could be. And then, of course, family offices and investors who may be looking to deploy capital and invest in some of these entrepreneurs that are buying businesses. A lot of these individuals and family offices were business owners once themselves. So that's a way they reinvest in that small business community, to stay involved and, of course, to see a financial benefit of their own. What we're going to cover today, we're going to walk through the core LOI terms, what that and why the LOI actually matters. We're going to discuss, the process of moving from the LOI through closing, the mechanics of the purchase agreement, and really why the terms of those purchase agreements are intended to allocate risk in the deal. And then, we're going to discuss due diligence and disclosure schedules. Due diligence is where we identify risk. The disclosure schedules are where we lock in the risk as of the date of closing. So when we have an issue, we can refer back to those and determine what we knew when we knew it. That's a benefit to both seller and buyer. And then, of course, the transition and post-close realities. The business means nothing if you don't account for how you will operate it and manage that transition. So this is important for both buyers and sellers. Sellers need to know what their obligations are post-closing and if there are any financial terms or incentives associated with the post-close operation. And buyers, of course, need to ensure that there is that transfer of knowledge that occurs. If someone has been operating a business for 15, 20 years, there's institutional knowledge that seller possesses. We need to make sure the buyer has a chance to download that information from person to person, human to human. So the high-level deal timeline, of course, if you're the buyer, you're looking to source the deal. We'll kind of get into what that means a little bit more, but sourcing That is either through, you're looking at biz buy sell, you're doing cold outreach, you've identified an industry you'd like to purchase a business in. So sourcing would be um, you are yes, the slides we made available. The sourcing you're going to be looking at biz buy sell. Maybe you're doing cold outreach to folks that have a business to see if they're interested in selling. If you're the seller, that means maybe you're listing it with a broker. Maybe you're going through a process to prepare it to take it to market. This often is, clean up financials, clean up contracts, clean up operational due diligence. So when it's time for a buyer to come in, you can hand it over and be ready for that transaction, which encourages higher valuation for that company when you go to sell it. Of course, once folks have identified the deal, yeah, once folks have identified the deal, the next phase is the LOI. There's a soft rule in between there that I constantly preach to any client is once you've sourced and you're moving to the LOI, in between there is really, the courting phase, the dating phase, because there is that transition period that exists. You need to make sure that the two of you being in many small business transactions, and, I think a big segment of the transactions we'll discuss here today are below that, $5 to $10 million range. Um, in that type of business, the leadership is often involved in the day to day and will be assisting with the transition. You don't have the benefit of a COO or a CEO that is not the largest equity holder in the company. Oftentimes, the largest equity holder is the seller and the CEO. Um, the you need to have a good relationship, both buyer and seller, to ensure there's transition, that you enjoy working with the person to download that institutional knowledge we were just discussing. Um, the let's see. For once you move into the LOI stage, um, you're going to discuss some key terms, right? We're going to outline what those are. And then you're going to move into due diligence, which, as we said, is identifying all of the different issues associated with the entity. And we'll drill down into what that means. The purchase agreement, uh, the financing, the closing, and the transition stages. We're gonna touch on each of those. So if you're the seller and you're bringing the business to market, you're either going to be doing a brokered sale or direct sale. So brokered obviously means I'm contacting a sell side broker. They're going to list and advertise the business for sale. If I am a doing a direct sale, that often means that someone has reached out and contacted me directly. So I, in that case, would be um, negotiating a deal at, maybe you have a broker, maybe you don't, maybe there's a buy side broker, but the relationship is often different than what it is in a brokered sale. Often the outreach comes, almost cold outreach from a buyer. And then, the financial quality that you can show is what is going to drive the uh, the value, the end value. So really, when you're preparing to take it to market, you want to, like I said, brush up your financials, pre-sale cleanup matters. That's organize your contracts. If you have been operating for years without a contract with somebody that you should have a contract with, you want to document that now instead of scrambling in the midst of a transaction to get it documented. Uh, so if you're a buyer, um, and I'm gonna stop paying attention to that chat bubble for a while. If you're a buyer, you often you'll go through a broker channel. Maybe that's biz buy sell. Maybe you hire a buy side broker, or you'll do proprietary sourcing. Proprietary sourcing, you see it a lot in search funds, independent sponsors, individuals who are really looking for a business that falls within a specific buy box, if you will. And there are also competitive versus non-competitive processes. Maybe there's an auction, maybe there is, basically you were engaged in some type of competitive bidding process in some scenarios. But oftentimes the two most are certainly broker channels whether that's a directory, Biz by Sell, or one of the other ones, Axial, that's out there, or proprietary sourcing, which is really just cold outreach. You're calling, you're cold calling businesses, seeing if they want to sell. Those are the two most common ones we encounter here. So the letter of intent, it's the blueprint of the deal, right? It's going to outline everything that goes into it. It's going to lock in your economics. It's going to frame the diligence that's needed. It's going to signal that you're serious about the deal, and it's ultimately going to dictate leverage in the purchase agreement. Now, what I mean by that, if the LOI is ambiguous, you're inviting conflict to occur later. Everyone will say, well, it's non-binding. You will hear brokers say this, it's non-binding. You can figure it out with the attorneys. It's establishing expectations. So if you then deviate from those expectations later on, um, everyone is going to view it as a promise between, at some level, human to human, because you're signing it, you're offering it. So it's going to be a source of friction if you then later decide to, renegotiate certain terms that were set forth in that LOI. There's a great chart. I believe this came from Axial. So a lot of deals die in the LOI phase. This identifies why they usually die. So it can be, a quality of earnings issue. You've engaged an accountant after you find the business you want to buy, and the quality of earnings report finds there are issues in the EBITDA that has been, shown when you were leading up to entering into the deal. You could have non-quality of earnings issues found in diligence. Maybe it's an undocumented contract. Maybe you found out the contract where a key employee cannot be assigned and that you're unlikely to have that, key customer, and you're unlikely for that key customer to come over. Renegotiation, oftentimes, as flagged in that LOI, maybe there's a term where you thought everyone was clear on it, and now you're engaging in some what is perceived as some type of renegotiating by the seller and the buyer, and there's just a disagreement. It also happens on the flip side. Sometimes the seller, after engaging their accountant after the LOI is signed, sometimes the seller realizes they made a mistake and their value should actually be higher than what was entered into. And they'll say, well, we didn't know this. We've discovered this in the accounting. Really, the deal's worth this. And, you have the seller back out over something like that. Sometimes it's financing. Sometimes it's just simply business underperformance once you get in there and see, the history of the business. We've had EBIT at this level in the past year. We had a 100% increase in EBITDA, and that's what was marketed. In reality, the business is in decline. We just had this outlier year. So a whole host of issues, but a large number of LOIs, a large number of deals die in the LOI phase, and this is the reason behind those falling apart. So the core economic terms that are going to go into your LOI, it's not just purchase price, right? Like when we prepare an LOI, it doesn't just say, I agree to buy Acme Company for $2 million, signed, and then we move to the purchase agreement. There's much more involved in that. So in the purchase price is often going to be some portion in cash. Maybe there's a seller note where the seller has offered some type of financing. You're going to account for working capital adjustments and other adjustments that go into it for debt. Or perhaps there is rollover. Perhaps some of the purchase price, it will come in the form of rollover equity, which basically means, we're buying the business for $1 million. The seller will roll equity to the amount of 20%, 20% of the million, 200,000. So we would attribute that 200,000 as, off the purchase price in exchange for that equity. You're going to identify how you treat debt and expenses of the business. And then, of course, the transaction expenses that are associated with, the actual deal. A little bit more on the rollover equity piece. So if you're doing rollover equity, which sometimes, in many cases, in the SBA financing, you're limited as to what your rollover equity options are. As stated just a minute ago, that example, we're doing $1 million transaction. We agree to roll over, say you're identifying 200,000 as the amount or 20%. That's where that factors out. If you're identifying, well, we'll roll over 15%, and then later on, you adjust that purchase price, you would still be 15% of the purchase price, whatever that is. So that's the first segment there, percentage versus dollar amount. Of course, you also need to decide whether or not that equity is voting or non-voting. Does that seller have a right to vote in any type of transaction in the future, or any type of governance question? A lot of times it is non-voting, or, in the examples we're using, 15, 20%, they're a minority shareholder, so they do not necessarily have rights. They don't necessarily have the power to vote in a way that controls the company. So that gets into the governance rights. Exactly what can they do? Are they a manager? Do we assign them any specific officer position that gives them rights? And then, of course, liquidity and exit timing. These are often tied to um, tag along and drag along provisions, which we're going to discuss a little bit more in a bit. Um, and that controls liquidity and exit timing. Just as an example, we could say, for 2 years, the seller will own their equity, but at 2 years, we have a right to force them to sell. Puts and calls. We have a put right on their interest. Um, and it offers downside protection. This keeps the seller interested. They want to make sure the business has success because they own part of it here. So, again, that aligns incentives, and the expectations are, you know, we want this business to succeed for both of us. Um, the diligence right in the LOI, of course, I mean, it has to be broad, right? I mean, you want to know everything that has gone on with this business. You're going to look at, you know, legal, financial, operational. Are you going to have access to employees, customers, systems? Most likely not, but you want to have access to key employees at some point before closing, to the extent they're a critical part of the business. If they're if they manage if you have someone who manages all the relationships and they say you cannot have access to this individual until the day of closing, well, that becomes an issue, because what if that individual has plans to start their own business? Oh, this was sold. I thought I would have a chance to buy it. I didn't. I have all the relationships with the customers. I'm starting my own thing and taking the customers. You bought a business with the assumption that it would have an X amount of cash flow. Absent those customers, because that individual left, you no longer have the business you thought you were acquiring. So access is a big issue with key employees as the deal progresses. Um, it's an argument we get into with brokers on a, you know, on a number of, on a not frequent but semi-frequent basis, because of course the broker wants to protect the deal, but we also need to protect, if we're on the buy side, we need to protect the buyer. Um, and then, of course, how can the buyer terminate the LOI? And is there a deposit requirement? Most deals under 5 million will require a deposit. I like to try to fight our way out of the deposit requirement because, once I give money to somebody, how do I know I'm going to get it back? They're usually contractual provisions around it being stuck in escrow. So, it's always best to keep the cash in your pocket if you can. Of course, on the seller side, it signals seriousness, so you're going to push for a deposit. Um, it depends on which side of the coin you're on. So, and of course, if you have exclusivity, you need access to the due diligence. Uh, so the moving into the financing portion of it. So we touched on the deposit part again. It's very difficult in lower middle market deals to get away from that deposit. Um, the deposit is sometimes tied to a financing contingency or best efforts language. I'll use best efforts to secure financing to, in the amount of X dollars or percentage of the purchase price. The A big part of it is SBA financing for those under $5 million transactions, and then seller financing, which is a seller note we touched on briefly. And then, of course, equipment finance, flexibility to the extent it is an asset-heavy business with equipment. Let's say you're buying a vacuum truck business. Those carry real value. Sometimes you can finance those because you're no longer just, you're not just financing cash flow, a business that is cash flowing. There's actually a hard asset. For some reason, if things go south, the lender could identify that asset and force a sale of it to recoup some of their loan. That's worst case scenario, of course, but I identify it because it is a financing vehicle that adds some flexibility to it. And, really, the seller is going to value certainty more than price. So, um, anything you can do to sweeten the deal from the buy side to sweeten the deal to ensure that you're going to reach closing, which again relates back to that initial relationship building. Like I said, you're going to have better chances, that you win the deal and that the deal is going to close. So due diligence, significant part of the transaction, right? Due diligence and the purchase agreement are the two most significant portions. So the due diligence, you're there to validate your assumptions. We assume that the business makes X dollars. We assume that it services this type of customer. We assume that it's growing or it's at least stable. We own the assets we say we own. We don't have the risks we said we don't have. So you're identifying the risks, and to the extent any of those assumptions or the risks are not what you expected them to be, you will use that due diligence finding to adjust the economics. Um, the financial due diligence, you're looking at the quality of earnings reports. This you engage a CPA. They're going to identify, they're going to climb through the books, ensure that the financial reporting is what is being represented to you. They'll provide a report and identify certain issues or errors or inconsistencies. Because really looking for that, is the revenue consistent? Um, if the year they take this business to market is showing abnormally high revenue, why is that? What is the trend over the past 4 years? Oftentimes, if you have an outlier year like that, it's because there was a big project that finished up, or there was one standout transaction that was not part of the business for the past 4 years. So, we can say, well, as the seller, well, we're going to have more of those transactions. That was our first test case of that customer. We have more coming down the line. Maybe, but that's a risk. That's a risk. So that falls into the customer concentration and exactly you know, what the risks are. Um, Contracts, key customers, key vendors, key suppliers, uh, lease agreements for manufacturing facilities. If you have some pieces of real estate you're using, are they assignable? Assignable? Are they nearing the end date? For a lease agreement, if it's an event space, um, and the lease agreement, you don't own the real estate, you lease the property, and the lease agreement is nearing its end date in 6 months, that's a risk because you'll have to renegotiate that lease. You don't know what the lease terms are going to be. If it's a vendor contract that had locked in pricing and that's going to end in a year, well, what's that new pricing going to be? If it's going to end in 5 years, you have some certainty to figure out, in 5 years, if that's the correct vendor or supplier for you, or should you take it to market and find out, see what other competitive prices are out there. Compliance also in those agreements that you're looking at, you want to make sure that the covenants, the promises in each of those contracts remains true. If the seller has broken any of those covenants, now there's risk. Have they received any notice of default with those? And all of these disclosure schedules and the due diligence really tie back to the purchase agreement, which we're going to discuss here in a little bit more. But oftentimes the representation in the purchase agreement says there has been no material change in a customer's ordering over the past, year, 18 months. If that's not true, they have to disclose it. Same with broken covenants. We have not received notice of a default under any agreement that we are a party to, that is material to this transaction. We, of course, need to identify what material means, but if it's a material agreement and we've received notice of default, the seller needs to identify that, list it, provide the facts around that. So again, we can identify risk and understand if there is an issue with that agreement continuing in place and if it's important to us. Litigation, is there any pending litigation? If you are a widget manufacturer and there is a products liability lawsuit because your widgets have been shown to cause injuries in a certain fact pattern, we need to know that. We're buying a widget factory, our business is widgets. If that widget is found to be, the source of personal injury, and now we're looking at a lawsuit, we're going to have to figure out how to remake those widgets so it doesn't cause injury. We need to know that. And of course, liabilities. Most common one, debt. What debt exists on the assets that we are buying? That will show up in the form of UCC filings or other lines of credit. And again, back to the vacuum truck. If I'm buying a fleet of 10 vacuum trucks from a business and all of those have $5 million in loans covering them, I need to know that so we can ensure that at closing, and a percentage of that purchase, well, the amount of that purchase price attributable to the outstanding debt is paid off and not just, um, we don't just proceed to closing without paying that off. You're looking at operational due diligence. So again, who are the key employees? We need to see an employee roster. We need to know what everyone is doing, how long they've been with the business, um, how much they are paid, what their benefits are. Because again, if we're looking to continue operating that business, we cannot, you know, we're not going to materially change what those employees are receiving. Oftentimes, what we see is there's a retention bonus paid, but we're not going to, you know, take away benefits in those scenarios. So we need to know what exactly they're getting. Are there non-competes in place for key employees? For example, if you have, a chief revenue officer at that company, or the, lead sales manager who knows all your biggest contacts, knows all the biggest customers at the business, you're going to want to hope that you have something in place to ensure that scenario I mentioned earlier, that individual doesn't walk out the door and take the business down the street to somebody else or open their own shop. Um, Another operational issue, customer concentration. If 80% of your revenue comes from one customer, that's a concern. That could torpedo your entire deal if that customer leaves. So really you're looking, you want to gauge that customer concentration to see, what the risks are around that. Um, Vendor relationships is there a vendor that is key to your widget manufacturing? Do they provide, the materials and are they your go-to for sourcing specific materials that absent that relationship, you won't receive that material anymore, and you're gonna have a supply issue. That matters. Are they terminating that relationship? Are they materially increasing the price by 100%? That's going to change your economics. So all of that stuff is necessary to understand. Uh, so the disclosure schedules are born from the due diligence. So in the purchase agreement, we have these representations and warranties. There's been no material change to the customer contracts. These are the material contracts that were entered into. The disclosure schedules identify all of those things you identified in due diligence that we have decided are relevant under the purchase agreement. We're going to get into that just a little bit more as we move along, but you really need to tie in, what am I asking for in the purchase agreement, and am I receiving it in the due diligence disclosure schedules? They're going to cover financial, legal, operational, all those items we just tied into, and they provide protection to the parties. If you're the seller and the buyer is complaining of something, you want to be able to point to the disclosure schedules and say, we disclosed this here. This is exactly as we had disclosed it. There is no issue. Sorry, we have this misunderstanding, but you knew about this going into the transaction. There's no dispute here. If you're the buyer and you find out, look, we never knew about this non-compete. We never knew this other person had this right that existed. I need to pursue a remedy. You want that, you know, really in that instance, you want to be able to show that it's not in the disclosure schedule, and therefore you have a right to pursue a remedy that is provided for under the purchase agreement. So the biggest deal killers in diligence, of course, are issues with misaligned expectations or truths, and issues with key agreements. So is there assignability? Are there assignability issues? Is somebody terminating? Is a supplier deciding to reprice their cost sheet, their pricing sheet? Um, and as a result of that repricing, are you expecting a 20% increase in expenses? Important things to know when you are, in an SBA loan, personally guaranteeing millions of dollars. Um, you can run into, the buyer may run into financing issues. And oftentimes, if there's a financing issue, it can usually relate back to something discovered in the due diligence or something, whether that be legal, operational, financial. If, the customer concentration is too high with one or two customers, the lender may not go through with the deal because they're concerned there's too much risk. Same with the supplier. If the supplier is completely material to you having a successful business, and there's reason to believe that that supplier is going bankrupt or they're repricing or whatever it may be, the lender is going to analyze that risk and decide whether or not the financing is appropriate. Um, and of course, seller fatigue. It's a common one. Everyone gets it. Buyers get it as well. But of course, the buyer and seller, you would think of something to look forward to, right? Seller is going to receive money at the end of it. Buyer is going to receive a company. But you often see it on the seller side because they are asked so much. Due diligence, clean this up, do this. Where's this? They're asked to explain every intimate detail of the business in a short period of time to push towards closing, and they just get tired of doing that. And the reason that, you know, that fatigue also exists is because the other common saying is time kills all deals. If a deal drags on, it's going, the increases of it dying increase one way or another, whether or not that's a shift in markets, could be tariffs, could be war, could be just market shifts, could be change in interest rates. All of these things change. Uh, they might not change tomorrow, but they might change 3 weeks from now. So time kills all deals. Seller fatigue can set in for a number of reasons. These are issues that pop up. So really, turning to the purchase agreement, which is the larger and meatier part of this, the transaction. I would say due diligence and the purchase agreements are two of the heaviest lifts. Um, what the purchase agreement really does is it allocates known and unknown risk. It converts what you find in due diligence in those risks that you find in there into remedies. And then in providing for a remedy, it converts that remedy into dollars. It forces operational clarity. So, you know, if there is a question as to how something is going to be handled, you want the purchase agreement to lock in the parties' understanding so you can always refer to it. It's not just there as, for legalese and shifting risk. If something goes happen, oh, it's this is the remedy. It's also there for everyone to say, look, this is how we said we were going to handle it. It was or was not handled this way. We need to fix it. We need to align with the purchase agreement. It locks in the parties' understanding and provides operational clarity. And that in turn avoids disputes, or at least tries to, right? So um, a big part of the purchase agreement obviously is outlining the purchase price structure. So in the LOI, you've most likely identified this. Broadly, in the purchase agreement, you're going to drill down a little bit more and clearly identify, you know, the breakdown. So cash, obviously, immediate payment at closing, buyer bears the risk. Buyer is paying in cash, that money is, gone out of your hands. A seller note is a deferred payment to the seller. There's some shared risk there because oftentimes a seller note has some form of right to set off against that note. Let's say, working capital adjustment, which we discussed later, or some other indemnification issue, or some other debt pops up. Oftentimes we'll say, well, to the extent we identify a $10,000 problem, we have this $100,000 note, we can just not pay seller that $10,000. So we didn't hold back the cash at closing, but now we have a right to not pay them the $10,000 over the length of that note. So that's a shared risk in that sense. In the rollover equity, which we said before, the seller is receiving a portion of equity in the acquiring company. So target co being the seller, buy co being the buyer. Rollover equity, the seller will receive some equity in buy co. That aligns the interests. The seller wants to make sure that there's that download of knowledge to the buyer to ensure they're successful and ensure that their equity in BICO is continues to appreciate. The last thing they want to do is roll over equity just to have the company die. So the interests are aligned there. And an earnout is similar in many cases to an earnout is different than a holdback or an escrow. An earnout is really if this company hits certain metrics, you agree to stay on as an employee for 3 years. If the business increases its gross revenue or net revenue by 30% over that time, then you'll receive an earnout equal to X amount of dollars. So again, it incentivizes the seller to assist in the business and to continue to make it more profitable, or at least sustain its profits. So the working capital adjustments are the you know the stickiest of issues in all transactions for buyers and sellers, because it's a concept that people aren't really used to. It impacts real dollars. You're looking to normalize the money that makes this business work, um, and it's often the first place that conflicts you know arise. So just as an example, everyone's going to receive the materials from this, but I've included this example. I'll give it just 10 seconds. And again, I encourage everyone to read through it, plug it into ChatGPT, discuss it, look at YouTube videos to work through this if you're looking to either buy or sell a business so you understand this better. Um, Everyone agrees the business needs a certain amount of cash to operate. There are receivables coming in, there are payables going out day to day. Nothing lines up on the first of the month. It's all fluctuates. If the seller drains the cash and doesn't pay bills before closing, you don't want to pay X amount of dollars when you expected this business to continue operating. You need to understand, you need to define what that means. What bills are being paid? How much cash flow do we need? What stays in the bank account? So, in the purchase agreement, we identify, what we assume to be the working capital, the normal working capital at close. This is an accounting function. Accountants are involved. Attorneys help draft the language around this, but it again, there's accounting is a big part of this. So really, if we distill it down, there's money coming in, and there's money going out. How are we going to make this work at closing? So at closing, we identify what we believe the peg to be, which is what, essentially the baseline. After closing, we have a true up period where we look and we see, okay, was this what we expected? Was this less than what we promised? And oftentimes, if there's a seller note or if there's a holdback or an escrow payment, or you're going to look for some other function to either offset the shortfall, if there was a shortfall in the working capital, or the buyer will need to release some of that cash held on hand to the seller if the working capital was determined to be too high. So again, you're buying the business, assuming a normal level of day-to-day cash and obligations. If it falls short, the price is going to get adjusted. If it's too high, price will similarly get adjusted. So if you are entering the buying phase, do some digging and diligence on this, because it's a tricky one to understand until you go through it a few times. Disclosure schedule is revisited. Again, disclosure schedules tie into the purchase agreement. The representations and warranties reference schedules. They are the written admissions from the seller, and the buyer is going to rely on those. It shifts risk, it creates remedies, and it surfaces the issues the sellers may not otherwise volunteer because you've asked for these representations. So just here's a sample representation, just so you get a sense of what these are asking for. So, in this one, no material adverse changes. We're looking for any adverse changes affecting the business operations. So, since X number of date, X date, or financial audit statements, the businesses have except for as shown on the schedule, the businesses have operated in the usual and ordinary course of business. No event or condition which individually or together would have a material adverse effect on the business. If you lost, if there was a lawsuit filed, if you lost 2 key customers, if you lost a line of credit that you were using to purchase supplies to manufacture your widgets, these are all going to be issues that would be listed there. So this is an example of how the representations in the purchase agreement tie back to the disclosure schedule. So the representations and warranties are focusing on financial statements, material contracts and customers, compliance and litigation. Is anything out of line with what we would expect it to be? Are all of the contracts up to date and in compliance? Or are there any covenants that have been broken? IP and data, if you are a manufacturing company or if you have some type of proprietary intellectual property, we want to make sure it's owned. We want to understand all the details around it. And then, of course, employees and benefits. All the employees, um, we've identified the employees, we've identified how much they're making, listed on the schedule. These are the benefits. Um, Essentially, these are representations are promises about the business. So we're stating things about the quality of the business. They really matter in indemnification. That's where your remedy comes into play if there's an issue. The indemnification mechanics. So to the extent, in an example where something was not listed on the material adverse effect section, representation, um, and we determined that that issue caused the business to lose $20,000. We would look to the indemnification provision to understand what rights we have. So you're going to have caps, baskets. Caps just mean, look, your liability is capped here. No, in no event will you be more liable for more than $100,000, seller. Baskets are basically, view it as a deductible. You have insurance, your deductible is X. If it's just a straight deductible indemnification, everything above that deductible you would be owed. In a tipping, once you reach $1 over that deductible, the deductible goes away and the seller is liable for the entire amount. So, there are escrows and holdbacks which can tie into the indemnity. And of course, as noted here, indemnity buys leverage because if you have a right to recover money against the other party, that's leverage. Again, just the basket has a minimum threshold, which once you tip over, that's your recovery. The cap, maximum exposure, you will not have exposure above X. Oftentimes, the maximum exposure is, could be the purchase price for certain representations. It could be, some other figure that's been agreed to for other items. So for example, if I represent I own the business, that would be a fundamental representation that most likely would allow me to recover up to the purchase price from the seller. So there would be no cap on that. But if the issue just relates to a lost customer, we could say it's capped at X dollars for whatever reason we may agree to there. So there's some certainty. So the covenants, while covenants are, I'm sorry, while representations are really, promises or representations about the business, the covenants are a promise to perform or not to perform. Covenant literally just means promise. So pre-closing, there's often a term in the LOI that says the seller will operate the business in the ordinary course as it has for all, ever since it's been operating right before the LOI stage. It has restrictions on changes and, you're also going to have access obligations, covenant to provide you with accurate financials, access to operational, information and key contracts. Post-closing, the covenants often come up in non-competes, non-solicits. I've sold my business, I have a restrictive covenant restricting me from engaging in competitive trade and practice. I also, agree not to steal the key employee for, the key sales employee for this new business that doesn't compete, because while that person sold for the business, I'm opening up something that isn't maybe competing, but I know that person is a good salesman. I want them with me. The non-solicit addresses that. Can't take my key employees. And it also has transition obligations. So post-closing, there will be covenants that obligate the seller to engage in post-closing transition activities. And really, those come down to, employment or consulting. A transition services agreement scope, it'll have scope and duration. So, again, you're transitioning. You need to download that institutional knowledge. The employees are familiar with the seller. They're not familiar with you. There needs to be some period of handoff, some period of transition. You also have issues around new bank accounts, new credit card processors, new, it was an asset purchase, you were going to have issues with setting up new trade accounts. The transition services agreement is going to say, I still get to operate under your trade accounts for 30 days until I get mine opened up. So as you can imagine, total chaos during those 30 days for the seller and buyer. You need something in place to obligate there to be a transition. This is also why the seller note and the set-off rights are important, because I want to be able to do, you know, I need something to keep that seller interested as the buyer, um, to ensure the transition happens. Because if I give them X dollars and they disappear tomorrow because I never had a seller note or anything to keep them incentivized, well, now I'm stuck. I need to figure all this out. I can't access their historical accounts. That's an issue. So these post-closing covenants are an important part of it. And often, like I said, it's in a consulting or an employment agreement context. In those, we'll also have customer introductions and vendor and knowledge transfer. Again, we want to make sure the vendors know who's coming in. A lot of times in small business, the vendors have close relationships. It's usually small business to small business. There needs to be some type of transition to help bridge that gap in the trust and the working relationship. So, um, assuming that we'll work it out later, we'll transition. I'll help you. Handshake doesn't work. We'd all like to think it works. We all like to hope the other person is human, but the only certainty exists is if it's in a written agreement binding upon the parties, and if there's some type of financial incentive. So, um, to finance the deal, you're going to have lenders and investors. Most common in this segment is going to be SBA loans, dominant funding mechanism in deals under 5 million. I'm sure, I'd also say SBA lending consultants it's a growing space at the moment. There are a lot of SBA loans being underwritten and entered into right now. Uh, Very dominant portion of the financing here. Seller notes, as we discussed, very common. That is a big chunk of a lot of this as well. Um, Equity, that's that rollover equity. It's less common, but it happens. Again, there are structures within SBA that are permitted and not permitted. You are more likely to see it in deals such as, private equity deals have a lot of instances of equity rollover. Um, Independent sponsored deals, which are, you know, usually slightly too big for SBA financing, have some type of traditional lending in place from a bank or institutional lender. You'll see it more frequently there. The last one, private credit, has been, an industry that has exploded over the past 4 or 5 years. Instead of getting your loan from a bank, you're getting your loan another private company. These these companies operate outside of the banking regulatory framework. They, of course, still have, you know, rules, regulations they must follow. But the private credit found its growth in the fact that it can operate faster than banks in many cases. It can operate a little more flexible. Um, and, you have a lot of investors deploying their capital into private credit funds who then loan out the money, and these investors receive their return through the interest rates that are tied to those loans. So private credit has been a big vehicle. Again, these items, that financing is generally seen in deals above 5 million. That's not to say it doesn't exist. It's, again, with that explosion, you may have businesses that are not well suited for some type of SBA financing, or maybe there's a shortfall. Private credit may step in, take a second, loan position, whereas the SBA financing has, essentially first shot at all assets, and anything left over would go to the subordinate creditor, being the private credit lender. But there are a lot of options out there for lending, um, and structuring that capital stack. Uh, Briefly covered. SBA loans are really just government-backed loans. You have loan originators that, um, you know, facilitate these loans, help underwrite them, work with you to gather all the documents that are needed. The covenants are often much tighter. The restrictions are, much tighter. There are regulations that must be followed, and there are personal guarantees. Um, Seller notes, it's with the seller. It's usually a 4-page document that we put together. It's 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 enforceable. It's clean. It's easy. It is not overly burdensome. The equity. There's a corporate governance aspect of the equity, which we're going to get into here in just a moment, but it aligns everyone's interests in the private credit or non-bank lenders. The timing runs parallel with diligence. Oftentimes, some of the financing is contingent on diligence reports. So, you want to engage and start that process sooner rather than later. If it's business found to have cash flow constraints that may not support the debt, the deal probably will not go through. You'll hear things like debt service coverage ratio, similar issues. Is the business going to sustain the loan? Corporate governance, this comes up in the equity. So if you're a single member LLC buying a business, very little issue. If you have investors or if the seller has rolled equity, does that investor or does that seller have decision-making authority? What are the economics that they get to enjoy? What happens when things go wrong? Who has management control? Obviously, the operations person should, but you know, those are complex questions depending on the structure of the deal. Um, you know, Investors are going to look for some type of voting control, board power, veto power. They're going to look for a preferred return. I get X amount out of this. In a sale, slightly more than you do. Buyer, operator, the one who found the deal. But then after the words, uh, we split it, or there's a catch up. There are 1,000 ways to structure these. And the capital calls, of course, if we fall short or if it's an investment structure, you may be able to look at that investor and say, hey, we need another $100,000 to fund this expansion. An investor may be willing to do that in the document because you've entered into this process for a specific reason to buy and expand the company you're buying. So this all is contained in the operating agreement, corporate governance. And then, of course, the exit and liquidity mechanics, which we touched on briefly. If it's a deadlock, what happens? Tag along rights. And drag along. If I sell it, I get to drag along the minority holders. If I'm the seller and the new buyer is selling and I'm a minority holder, I can say I tag along with that sale. I'm not left out here with my minority equity interest. And then puts and calls, you can force a sale or a purchase of certain members' equity, depending on what's in that corporate governance framework. Last section here. Thanks all for lasting through the hour. Transition to post-close. Close is not the finish line, right? So you got to, employment agreements, consulting agreements, you're going to have these in place with the seller. You should look to get these in place with your key employees. The transition services agreement, identify there are going to be accounts you need to switch over. Accounting, IT, payroll, vendor relationships, all of this has to be, some type of sprint to get this stuff transitioned over after closing. So, this transition is an important part. You can't have this stuff lingering out there. You don't want to try to figure this out on day 29 of a 30-day timeline or, day 170 of a 180-day timeline because things often take time to get switched over. The goal of the transition is to preserve relationships, transfer that knowledge, and ensure there's continuity. Customers and small businesses often have a relationship with key people, so there needs to be that trust built back up with the new buyer. And then, as we said, a seller who's been operating the company for 15 years has most likely not committed everything from pen to paper. There needs to be some level of knowledge transfer associated with that. And the only way you're really going to understand what needs to be transferred as a buyer is working in that business. There's no way you can accomplish it prior to closing. The most frequent mistakes are undefined scope. You don't want a seller to say, well, I said I would help, but we really never really defined what that is. I left a handbook on the desk, and the handbook is scraps of paper and receipts. Poorly defined scope is not going to assist you, to the extent you really need. When you've signed your name to a $3 million personal guarantee, you need something out there that says Seller, you're going to be here when I need you for at least 2 months. Um, Same, you don't want to over rely on the seller. You need to get this stuff learned personally so you can operate going forward. Um, Other non-competes, you're going to have non-competes with your seller. Do you need it with key employees? Are you going to pay them some type of bonus and as compensation for that? You might want to consider it. Earnout control, if there's an earnout, this is usually in a non-SBA finance transaction. If they're hitting certain metrics, how are those metrics going to be measured? Um, you want to make sure there's no manipulation of numbers or the ability of a party to manipulate the interpretation of metrics being hit. So, it's important drafting and important to mind those issues throughout the long term. Uh, Post-close operations. Here's a plug for the last SBDC talk I did. It'll be in the PowerPoint circulated. We did contract pitfalls. You're going to want to look at your contracts, identify certain issues that may exist. If you need to, go to market, find other more favorable terms. Um, of course, employee and incentive agreements. Are you offering up an employee stock option pool? What are you doing to incentivize employee buy-in post-transaction? Um, there are plenty of schools of thought over when you should make changes, not after 90 days, not after 6 months. You need to retain key people. The last point here, avoid unnecessary disruption. Originally I wrote measure twice, cut once. You're not really, cuts are not advisable unless there's a very good reason for it. You want to act once. So maybe that is, restructuring responsibilities, not necessarily cutting employees, but maybe shifting, certain burdens or redistributing them if one person is, kind of has the largest laboring oar of the group. Um, all right. Final two key takeaways. LOI drives outcomes. You're setting expectations. If you start renegotiating after the LOI, it is very possible that the deal falls through or that um, there are issues that existed in that LOI that were not properly addressed that could provide a financial windfall to either seller or buyer. The diligence drives leverage. If when you're doing that, you find issues such as the real estate lease agreement is going to expire on the manufacturing facility, and I have nowhere to move all of the equipment inside unless that lease is re-signed for the same or equal terms, same or um, you know, not materially worse terms. That's going to drive leverage. That's going to be a big factor in the price. And that purchase and sale agreement is going to allocate risk among that. Who, you know, what happens if something goes south? The transition, you need that knowledge to transition for there to be success. And, good deals are structured, not found. That ties back to the LOI and, of course, how you work it out through the purchase agreement. So, um, spoke a lot, didn't see a lot of questions come through, but if anybody has any questions right now, definitely would love to hear them and respond to them. And if not, you guys will have the slide deck emailed out to you. You have my phone number, my email address. I'm also on LinkedIn and write a lot about entrepreneurship through acquisition. If anyone wants to add me, I welcome the connection. I welcome emails. Happy to chat about this topic all the time. So, uh, yeah, thank you all. I appreciate you stopping in, and hope to see everyone out there in the corporate buying world.
Yeah, thank you, Mark. And thank everyone for joining. If you have any questions, we have about just a little like 2 minutes. If you have any questions, you can put it in the chat box so that Mark can answer it. Other than that, I shared a link, a survey link in the chat box. We will appreciate if everyone visits the link and then provides responses to a short survey concerning today's presentation. All right. Thank you guys for joining. Thank you, Mark, once again for your presentation. Yeah.
All right, sounds good. Thanks all.
All right. All right. Bye. All right. Thank you, Mark. I think there are
Yep.
no questions. Yeah.
All right, sounds good.
Nice meeting you. Sure.
Yep, likewise. Good seeing you again. Thanks.
All right. Bye. All right. Thanks.